next variation on the normal gain computation is in relation to non-wasting chattels. Now, first of all, it is important to define what these are. First of all, non-wasting. That means an asset with a life of less than 50 years. So it's not going to be something which is going to either fall apart within that period or, as is the most common sadly in the exam, something which is going to die. So for example, a greyhound or a racehorse, which might well be sold at a profit, are not non-wasting chattels. They are wasting, and therefore they are actually exempt from CGT. Chattels can be defined as tangible, movable property. So the best example of things which are not chattels would be anything intangible, such as shares, and anything not movable, such as land and buildings. Most other assets that are owned by an individual will be chattels. If they are wasting chattels, then they are exempt. And this is on the list of exempt assets in your material. If they are non-wasting, then these rules here apply. These are often referred to as the £6,000 rule because the question is whether sale proceeds are more or less than £6,000 and whether cost is more or less than £6,000. The easiest scenarios are where both cost less or both are more. If the asset was bought and sold for less than £6,000, it is simply exempt. No gain whatsoever. So most people's small disposals on eBay, for example, will be exempt from capital gains tax. Anything both bought and sold for more than £6,000 will result in a normal chargeable gain. No different rules from the ones that you've seen before. It's the two other boxes where we need to learn new rules. First of all, this box here. Here we are looking at a situation where the proceeds were less than £6,000, but the cost was more. So you can immediately see that you have a loss. However, because we are on this margin around £6,000, you don't allow the loss in full. Instead, you assume the gross sale proceeds were £6,000. They are deemed to be £6,000, and that will restrict the amount of the loss. The other different scenario that you can see is where the cost is £6,000 or less, but the proceeds are more. This time we definitely have a gain, but again it is on that margin, so they're going to restrict or potentially restrict the gain. That restriction operates by taxing the lower of two figures. First of all, the normal capital gain, which you can calculate using the normal rules, and secondly, a formula which again you do need to learn. That is that you take the gross sale proceeds, you deduct £6,000 and you multiply it by 5/3. And because of this, this is often referred to as the 5/3 rule. We're going to see these in practice in the next example. So in example 4, you're being asked to calculate Sally's net chargeable gains for 2015-16. We've got more than one disposal in this question, so we're going to have to net off any gains and losses. She sold 4 paintings. So first of all, we need to consider what kind of disposal this is. A painting is a chattel, but has a life of more than 50 years and so is non-wasting. Therefore, the £6,000 rules will apply. The first painting was acquired for £2,000, which is obviously less than £6,000, but sold for more, £7,000. So therefore, it will fall in the box for cost of £6,000 or less, proceeds of more than £6,000, and therefore it will be a marginal gain. So that first disposal falls in this box here. The second painting was bought for more than £6,000 and sold for less than £6,000. So again, going to the table, it was bought for more but sold for less. So this one, painting number 2, is a marginal loss, and the proceeds will be deemed to be £6,000. Let's just note those two on here. Next we have a painting bought for £3,000, so less than 6, and sold for £5,500, so also less than 6. This one falls then in the box for cost of less and proceeds of less, and so painting 3 will be exempt. Finally, we have one bought for more than 6, 7,000, and sold for more than 6, 9,500. So that one will fall in the box here, the normal chargeable gain. So let's just annotate those on the question. So we now know how we're going to deal with each of these disposals, and we're going to go through them and pull together the answer. So I've set up a table here, each of the ones that is not exempt side by side. We're not dealing with painting 3 at all in terms of calculations because it is exempt. We'll note that underneath. So we're going to deal with painting 1 first of all. The sale proceeds were £7,000 and the cost was £2,000. That gives us a chargeable gain of 5. However, for painting 1, that is not the end of the story because the 5/3 rule will apply. Therefore, in this situation, the gain cannot exceed 5/3 of the proceeds less £6,000. So that's 5/3 times 7,000 minus 6,000. That gives us a maximum gain of 1,667. And that is actually the gain that will apply because it is less than the chargeable gain of 5. Secondly, we have painting 2. This was the marginal loss painting, so we use deemed proceeds of £6,000 and ignore the actual proceeds of 4,500. We use the real cost of 8 to give an allowable loss of 2. Finally, painting 4 is a normal gain, so we have proceeds of 9,500, cost of 7, giving a gain of 2,500. So then the net chargeable gains for the year will be the total of the 1,667 less the £2,000 loss and adding on the £2,500 gain. That gives us a net gain of 2,167. And I've got a note here, painting 3 is exempt as the cost and proceeds are both less than £6,000. So that's the end of this example.